Hi, it's Josh Brown. I'm here at the compound with Ben Carlson and Michael Batnick.
That is such an aggressive introduction.
I don't care. We're going to go with it. I am here to talk about Ben's new post, What If You Retire at a Stock Market Peak?
You're yelling.
Stick around. Ben, I just read your new post, and I was saying to you before, it's like, to me, this is like the perfect thing to write based on what we do, because most of the people that come to us and they say, all right, this is my life savings or this is my existing portfolio, and I feel like I'm going to give it to you and the market's going to drop. Like that's going to be the top of the market. So you're talking about what happens if somebody goes into retirement right before one of the most famous crashes. And I think you look at the one from the 70s, the 1929, and the more recent example to make the point that it's not the end of the world if that's what happens.
That's like the huge nightmare. I retire, I have all this money, nightmare. And then the next day, part of my portfolio is chopped in half or whenever it is. And so I looked at the performance from the Great Depression, the 1973-74 bear market, and then the 99 top, and said, what happens if you had a balanced portfolio going into that? How screwed were you?
What's a balanced portfolio?
So I did a 60-40 portfolio of the S&P 500 and 5-year treasuries.
Where's gold?
Okay, so 60% is S&P 500, 40% is a treasury bond portfolio.
Yeah.
And the idea is just like that's an approximation of what a balanced investor would look like.
Yeah, and
the funds obvious you own is not the point.
The obvious caveat is in 1972 and 1928, you couldn't have invested in this probably. But the point was to look at what happens when you have horrific performance in stock market. How does that impact taking a 4% withdrawal rate from your portfolio?
So so let's look at the numbers for a sec. So you have the 30-year period from 1929 to 1958. You started at $1 million, inflation adjusted, and you ended up 30 years later with $2.2 million, but you took out $1.2 million. So it's 4% every single year, regardless of inflation or anything, just 4% a year.
Correct. So the first one I looked at, and what I got into once I started running these numbers, it made me realize this is really hard to map out over even using a spreadsheet and some simple assumptions because...
What was hard about it?
Well, I started off just using a flat 4% rate, but then you get into the idea of, well, if you took just 4% every year and your portfolio is fluctuating enormously, that means your income is going to fluctuate enormously. So I did that. I did this in the first one where I just took a flat 4%. And then I said, well, in the 20s and 30s, you had deflation. So your standard of living would actually been
your cost of living would be lower.
And then in the 70s, you had huge inflation. So I said, all right, so my second example, I said, what if you increase that 4% by CPI every year? So in the 70s, you had to ramp up your spending a lot.
Right. Just to keep pace with the cost of your lifestyle.
But after the Depression, you didn't need to spend.
You actually didn't need to spend as much because there's deflation.
So the obvious hole in this analysis is that there's no taxes considered.
So I talked to our resident tax expert, Bill Sweet, and he said, all right, let's say you're taking 4% of $1 million portfolio, and that's coming out of an IRA. You also have to take into account things like Social Security, other sources of income. So let's throw those aside. Again,
Social Security as a benefit,
right?
In addition to,
in terms of your income and what you'd be paying on taxes, he said, let's look at a New York State resident. If that $40,000 is your only income, you're paying like 7 or 8% in taxes, roughly.
So not a huge consideration.
So not a huge consideration, again. But that kind of shows how difficult it is to really map out one of these things, and it just made me realize more and more that this thing you have to be really flexible with this type of thing. If you're going to draw down a portfolio, you can't look at it on a spreadsheet and think this is exactly what I'm going to do, because your spending is going to change. The value of your portfolio will change.
Isn't this why, though, people actually need a financial planner?
Yes, I think I served that one up pretty good for you, didn't I?
Yeah, well, I mean, the returns are the returns.
Yes, exactly. No, it's true. And it's
true. You
can't
really do anything about what period of time you're about to retire in.
Right.
When it's time to retire, it's not like, well, I think the stock market will be better if I just work another 2 years. No one's really doing that.
Right. And yeah, it requires a lot of flexibility and nuance, and then reassessing as those numbers come in, because those numbers are never going to be the same every period for everyone who retires. You reassess where you are on that time period based on your spending and your level of your portfolio and whatever else.
Let me poke a little bit more. So you used the starting date in 1973, which was the top for the equity market, but bonds in this 30-year period from 1973 to 2002 were an enormous tailwind for traditional portfolios.
That's why in the first example, the 70s actually, you did amazing because you had the 80s and 90s bull market, which was 17 or 18% a year in stocks, and then bonds did probably 7 or 8%.
So I guess from where we are today, people would say, yeah, that's great. If you invested in 29 and 73, but today we're at a place where valuations are high and interest rates are low.
So look at the 2000 period. Valuations were even higher. Rates were much better then. I think
So
rates
what
were
rates? 6?
5 or 6%, probably, going into the late 90s, which people would just kill for today. So I think, but that was a period where you had 10 years of zero growth in the equity markets,
Right.
or actual losses, especially even on a real basis. It was even worse.
So I guess poking hole in you is that you're literally showing if you invested at the top of the equity market. So is there a scenario where like this just gets blown up?
I think it probably would be
Sequence of returns. Like if 1929 happened in the last 5 years of your retirement, right?
Yeah,
then you might live the rest of your retirement in much worse condition than you originally thought, but not definitely, because you're 30 years into retirement at this point. You're very old.
And the other thing I took into account here, I
To
used
spend down more, in other words, with less fear.
if it happened the timing of it is huge, but I also took just the returns of a annual rebalance 60-40 portfolio. So let's say instead you use more of an intelligent rebalance and you don't take from stocks when they're down.
Well,
and
that's
maybe
a
take
good
from
point.
bonds. Maybe you're improving your results a little bit. So I think that there is a lot of little tweaks you can do here and there that actually make for better withdrawal strategy.
But then those tweaks are like, all right, I'm changing the rules as I go. Like somebody,
Right.
like I feel like you need somebody to be like, all right, that's common sense. We can do that. Or no, we're not going to do that. That's a bad idea.
Do you need like a rules-based strategy for retirement? Isn't there a lot of room for common sense?
Yeah, but I think you
Depends
need
on who you are.
rules, and then you need some flexibility
Like
to say,
guidelines.
Yeah, I think you definitely need some guidelines. Otherwise, you're making it up, and then when your portfolio does well, you're probably spending too much, and when your portfolio doesn't do well, you're probably spending too little. So I think there has to be middle ground.
Now, the investor in the 70s didn't have the benefit of being able to go on a website and run simulations.
Correct.
Or
Right.
the benefit of knowing what the future is going to be.
Well, obviously,
I mean-
none of us have that now.
But I'm saying like these look really good right now, but like you didn't know at the time.
No, you couldn't have known. And in fact, if you were the example of the investor who retired in 1972,
You had a pension.
you had a pension, you weren't really responsible for your 401k, you had some guarantee. You definitely couldn't have done index funds. They didn't really exist yet.
Probably
you could have
weren't
a few
living.
years
Probably
later.
weren't living to 95.
You were paying huge costs to build these portfolios. You were paying the spread on your treasuries.
So we've spoken about this a lot. That gross returns might be lower, but net returns might
Might be higher. It was right. So
Equivalent, maybe.
for everyone who says valuations are so much higher now, there's not going to be as much opportunity. Okay, but it also doesn't cost me 7% net to implement a portfolio across 3 or 4 asset classes, and that's got to count for something after tax, after everything.
And my other sort of huge takeaway here is that, like, all of this has to go beyond the portfolio, because you can create the world's best portfolio, but if you don't have a plan to take money away and you're just doing this, on your own, I think it's really hard to come up with a plan that actually
Where
works.
if you're like, it was a really good year in the market, let me take out X dollars.
Yeah, so I think you do
That's
have to
not
have
going to work.
Yeah, and why financial planning is like this process and not an event. You can't just plug it into a spreadsheet, hit go, and then you're all set.
Yeah, I think that's really the key takeaway point for me. A lot of the industry used to be, you go to a financial planner, they're like, all right, for $5,000, I'll give you a financial plan. And it's like a binder. And they're like, okay, here you go. You paid for it. Now, if you want me to be the broker to implement the trades I'm recommending, you can, or go to someone else. That's not really financial. Financial planning is, I've gotten to know you. I know what you're susceptible to. I know what you need me to say to you. And I know what we're trying to do with the plan. And I'm the person that helps you make those alterations in real time when I have to. That is ongoing financial planning. So, all right, Ben, thank you very much. If you haven't read the article, we're going to link to it below. Let us know what your thoughts are. And thanks for watching. Be sure to subscribe to The Compound. We love all your comments. We love all your subscriptions.